Hello friends, welcome, and in this session I will discuss many important concepts from the public finance chapter. So we are in the public finance chapter and we are studying Indian economy for the prelims examination. So first of all, what is the coverage of this session? So in this session, we will discuss about off-budget liabilities or off-budget obligations. Then we will discuss fiscal slippage, fiscal consolidation, fiscal prudence, fiscal stimulus, fiscal marksmanship, fiscal space, fiscal drag, fiscal profligacy, and fiscal capacity. All these concepts seems to be very similar, but all of them have different meaning and they are applied in day-to-day function by the government. So let us start with the off-budget liabilities or off-budget obligations. So if we see this term has three words: off, budget, liability. Off means it is outside the budget. It is not inside the budget. Budget and liability. Liability means it's an obligation. It's an obligation which has to be paid by the government. Now, any obligation which has to be paid by the government, why it is not part of the budget? Why it is outside the budget? So this is outside the budget because we follow accrual based system of accounting. Accrual based system of accounting, right? So what is accrual based system of accounting? So to understand accrual based system of accounting, we have to understand cash based versus accrual based. So this is cash based and this is accrual based accounting. Suppose in the month of April 2020, the government gets the bill of 100 crore rupees from a road contractor. Out of this 100 crore bill, the government pays in the month of April suppose 40 crore and in the month of May only 50 crore and in the month of June rest 10 crore. As per the cash based accounting, in the month of April 40 crore rupees will be booked as an expenditure, and as per the accrual based accounting, total 100 crore rupees will be booked in the month of April only. So in case of cash based accounting, we see how much is the cash transaction. So in this case, cash transaction in the month of April is 40 crore rupees. In case of accrual based accounting, we see how much is the total bill. So it might be paid in cash during this month or maybe in future, but this has already been billed, so this is due from the side of government. Once it becomes due, it comes in the same month. So in cash based only cash transaction, and in accrual based the due transactions are noticed. So here due basis and here cash basis, right? Now coming back to the off budget liability. So the off budget liabilities occur because our budget is prepared on the cash based budgeting. Our budget is prepared on the cash based budgeting, and there are some obligations which are due but not being paid. So those obligations might become part of the off budget liability. Now let us see an example. How does this work? So you might have heard about the term oil bond. And before I discuss this term, you might know that government provides fuel subsidy. How does this transaction happens? So the fuel subsidy is provided like this. Suppose we have the company Indian Oil Corporation. Indian Oil Corporation is a oil marketing company. So Indian Oil Corporation, the cost of per liter petrol is 100 rupees, and as per the government rate, the sale price is rupees 70 only. So it bears the loss of 30 rupees. This loss of 30 rupees is compensated by the government in the form of fuel subsidy. Fuel subsidy by the government. So this 30 rupees loss is borne in the form of subsidy. This subsidy is basically revenue expenditure as far as the budget is concerned. So in the budget, this is the revenue expenditure, because this does not impact the creation of asset and liability. Now, if this subsidy is paid by cash, if this subsidy is paid in cash, then this will become part of the revenue expenditure, and this will be included in the budget only, and it will be reflected in the revenue deficit as well as the fiscal deficit. But if in some year it is quite possible that government do not have the sufficient resources, if the government do not pay in cash, but it allows issue of oil bonds by the OMCs, that is the IOC, Indian Oil Corporation, or it issues itself the oil bond for paying to the IOC, right? So oil bonds, either it can be issued by the oil company itself on behalf of the government, or government can itself issue these bonds, right? So the amount which is received from this bond receipts, they are received to the IOC, they are paid to the IOC. So these receipts are not coming to the government, because they are not received by the government. Therefore they do not become the current year liability. So they do not become part of the capital receipt, that is they are not included in the borrowing of the current year, because our budget is prepared on the cash basis. But in this particular transaction, the government has not received the cash. It is the oil marketing company IOC which has received the cash. Because the government has not received the cash, therefore it is not reflected in the budget of the government. Therefore it is not reflected in the deficit also. So it is not impacting the revenue deficit, because it is a revenue expenditure. Despite that, it is not impacting the revenue deficit, and despite it is capital, it is the borrowing, it is not impacting the fiscal deficit also, right? So overall, it is not impacting the deficit also. But in future, this is to be repaid by the government only. So the central government has to repay the bond amount to the bondholder, as well as on an annual basis it has to pay the interest. So it is the obligation of the government only. But this obligation is not in the current year. This will be paid in the future years. So whenever it will be paid, it will be reflected in the balance sheet of the government. That is, it will become part of the budget of the government, and it will be reflected in the deficit. So this situation happened when during the UPA government, the oil prices were rising very, very high, and the UPA government issued oil bonds. Now in the recent couple of years, in 2017, 18, 19, the present government repaid the bond holders amount which were issued during the UPA time. So at the UPA time it was off budget liability, and during the NDA time it became part of the deficit. So this is one example of the off budget liability or off budget obligation. Another example can be, for example, in case of food subsidy. So if in any year the Food Corporation of India does not receive the money from the government can allow the FCI, Food Corporation of India, to issue the bonds on its behalf, and in the future these bonds will be repaid by the central government. So this can also become part of the off budget liability. There is another obligation which can become part of the off budget liability, that is contingent liability. So what is contingent liability? Contingent liability happens when central government gives the guarantee to someone that I am guaranteeing you, if you give loan to this person and this person do not repay loan to you, then I will pay on his behalf. So this guarantee can happen. For example, central government says to the RBI that please give loan of 10,000 crore rupee to UP government, and if UP government do not repay, then I will repay your amount. So normally it is not the obligation of the central government, but in case UP government fails to pay, then because central government has given the guarantee, so central government in case for the central government it will become the liability of that particular year. So the liability is contingent upon whether the UP government is able to repay the loan in future or not. That is why this is called contingent liability. So in the contingent liability we can have the items like oil bonds and contingent liability. Now let us see in terms of language. These liabilities arise not because of borrowing or use of public money by the government. So government has not borrowed the money directly. These are money liable to be paid to the government to various entities as a policy matter. For example, government does not allow oil marketing enterprises to raise prices when the price of crude oil rises. To bear the losses to these oil marketing companies, it issues interest bearing bonds. These are not considered in the calculation of the deficit. This is very important. You have to keep this in mind, that they are not considered in the calculation of deficit in the budget, even though they are borrowed expenditure. This is called off budget liabilities. So this is all about the off budget liability. I hope the concept is very much clear to you. Now next term is fiscal slippage, right? So if we see the term fiscal, that is, it is related to the government treasury, and slippage means there is some lag, right? So fiscal slippage, what is fiscal slippage? Basically, as per the FRBM Act, as per the FRBM Act of 2003, there are some upper limits with respect to the fiscal deficit and even for the revenue deficit as a percentage of GDP, right? So this fiscal deficit or revenue deficit, for example, this fiscal deficit is 3%. And in case of revenue deficit, earlier it was 0%, but as of now the government has not defined any particular target, but the government tries to reduce it to 0%. To achieve this 3% and to achieve this 0%, every year the government has sub-target, that okay, suppose this year the fiscal deficit is 3.6%, so we will try to reduce it to 3.3% in this particular year. Right, so this is the target of a particular year. So suppose this actually happened in the 2018-19. So for the year of 2018-19, the target was 3.3%. But when actual figures came, this budget, this fiscal deficit was more than the budgeted deficit. That means there was slippage. So whenever the actual deficit is more than expected or budgeted deficit, then we call it fiscal slippage. This is very, very simple concept, right? So you can see over here, if the actual fiscal deficit is more than what was expected, it is called the fiscal slippage. The example has been given for the budget year 2018-19. So this is very, very simple and direct concept. Now comes fiscal consolidation. What is the concept of fiscal consolidation? So here the word consolidation means basically consolidating the financial position of the government. That means controlling the fiscal deficit of the government. So when the condition of the government finances is poor and fiscal deficit is rising, it has to be controlled. Why it has to be controlled? I hope you remember when I discussed the concept of fiscal deficit that there are three major drawbacks of the fiscal deficit. What are those? Can you think of? So take 10 seconds and just think what are the three drawbacks of the fiscal deficit. Then we will discuss this. So three drawbacks of the fiscal deficit are: number one, it is inflationary in nature. Why? Because fiscal deficit means the government will spend more money into the market. Money supply will increase in the market. That will increase the purchasing power of the people. That will increase demand of the goods and services. But supply cannot increase suddenly. So demand is increasing but supply remains constant, or it does not increase in the corresponding ratio. In this case, the prices are bound to rise. Therefore, we say fiscal deficit is inflationary in nature. And inflation, if it goes beyond a level, if it goes beyond 6%, then it is very, very bad, because it impacts the poor people in a very adverse manner. So this is the first reason why fiscal deficit is not considered to be good. Second, it puts a burden on the future generation, because fiscal deficit means we have to take the loan. If we are taking the loan today, in the future it has to be repaid by the future generation, and mostly it has to be repaid in the form of increased tax rate. So our children, our future generation has to pay more amount of taxes. So it puts a burden on the future generation for the spending which has been made by the present generation. So it also creates intergenerational conflict. Number three, this crowds out private investment. Why? Because market has a particular amount of finance available. If government takes the loan from the market, the amount available for the private sector is reduced. So private sector gets the less amount of money for investment, and the rate of interest also increases. So the private investment reduces. What is the adverse impact of that? The adverse impact of reduction in the private investment is that the overall capacity of the production capacity of the country decreases. So that decreases the GDP of the country. That means the economic growth rate declines. So first adverse impact was inflationary. Second, it creates obligation on the future generation, and third, it crowds out the private investment. Because fiscal deficit is not good because of these three reasons, the government always tries to reduce the fiscal deficit in the long term. So in the long term, this fiscal deficit can be controlled especially through reducing the revenue deficit, right? So revenue deficit is part of the fiscal deficit, right? So fiscal deficit is the total deficit, overall deficit, and revenue deficit is basically part of the fiscal deficit. What is revenue deficit? Revenue deficit means when the revenue receipts are less than the revenue expenditure, or when revenue receipts are not able to meet the revenue expenditure. So we want to reduce the revenue deficit if we want to do the fiscal consolidation. To reduce the revenue deficit, there are two way outs. Either we will increase the revenue receipts, or we will decrease the revenue expenditure. What is the meaning of revenue receipt? Revenue receipt means the receipt which does not impact the asset and liabilities of the government. The receipt which do not reduce the liability the receipt which do not increase the liability and the receipt which do not decrease the assets. So that is revenue receipt. So it can be of two types, either it can be tax revenue or non-tax revenue. Tax revenue can be increased by increasing the tax rate, but it has limitations. India is already highly taxed country. The rates of personal income tax, GST, etc. are already high. Therefore, this has really big limitation. Non-tax revenue like interest income and user charges, those can also not be increased suddenly. So increasing revenue receipts has its own limitations. Although from time to time government keeps looking for different ways out to increase the revenue receipt. For example, levying cess on the high personal income people. The second option available is reduction in the revenue expenditure. Reduction in the revenue expenditure is possible because our expenditure efficiency can be enhanced. The government has really been working in this direction by introducing the concept of Jan Dhan account, Aadhaar and Mobile Yojana. This JAM scheme can actually is actually making a real difference, because through this the direct benefit transfer is done. The amount is directly transferred to the account of beneficiary. So all the middleman commission, that is not required to be paid, right? So this is how we can control the revenue deficit. So fiscal consolidation are these kind of strategies, and then there can be many more such ways out to increase the revenue receipt and decrease the revenue expenditure in the long term, right? So this is the long term strategy. In the short term, government can also go for the increase in the capital receipt or reduction in the capital expenditure. So government can go for the disinvestment, and in the recent couple of years the government is going for the disinvestment. So one thing I want to tell you, we cannot say that fiscal consolidation happens only through revenue transactions. It can also happen through the capital transactions, right? The main thing is that fiscal deficit is tried to be controlled in the long term. This is fiscal consolidation. Now, next term is fiscal prudence. What is the meaning of fiscal prudence? First, what is the meaning of word prudence? Prudence means being pragmatic and being conservative. In the context of fiscal matters, what does this mean? So, when the government is preparing the budget, it is estimating two things: the receipts and the expenditure. Now, these estimates of receipts and expenditure, they should be pragmatic, they should be conservative. That means we should think that there can be some unforeseen bad situation in the future, because of which the receipt can come down and expenditure can increase. So keeping the high estimate of expenditure and keeping the low estimate of receipt, and accordingly making the budget, this concept is called fiscal prudence. This concept is called fiscal prudence. And the most recent example of unforeseen situation is this corona based countrywide lockdown. So because of this lockdown, the entire economy has come to a shock. So entire country is in a shock, economy is in a shock, all the production is stopped, tourism, travel, everything is stopped, and because of this the government tax receipts are coming down, because no production is happening, no income tax will be paid. That expenditure is increasing because the government will pay the welfare expenditure to the migrant workers, to the farmers, to other stakeholders, right? So all being pragmatic, being prudent is fiscal prudence. Inside this, the government can also go for cutting down the government expenditure. It can go for cutting down the government expenditure. For example, during this corona lockdown only, the PM, president, etc., they have declared that they will get a self-declared cut of 30% in their salaries. So this will inspire the other public officials to reduce the salaries on a voluntary basis. So this is how the fiscal prudence works on the practical in the ground level. So this is the concept of fiscal prudence. Now coming to the fiscal stimulus. So this is a stimulus. Stimulus is, it's a kind of injection or booster. It's a kind of booster. So many a times the government is in a bad shape. This can be because of some global factors. For example, during 2018-9 there was a US subprime crisis. Or this can be because of some other factors. For example, corona lockdown. Or there can be cyclical slowdown also, which we have been facing since the mid of the 2019. Because of this bad shape, there might be requirement of government expenditure, so that the aggregate demand of goods and services can be increased in the society, right? So when economic growth rate is falling, GDP is falling, production is reducing, the people are losing the jobs. In all these bad economic indicators, amid all these bad economic indicators, the government wants to boost the GDP of the country. Government wants to create the production in the country. So government will boost the production in the country by spending on the people. It will spend on the infrastructure, it will spend on the welfare measures and on other areas. So when spending will be going into the market, it will increase the money supply in the market. When money supply increases, that will create purchasing power in the pocket of the people. If purchasing power is created, that will create demand in the market for the goods and services. When demand is created, then automatically the production will also increase. That will bring back the jobs, the GDP rate will increase, economic growth will increase, and ultimately that will increase the tax revenues of the government. So in the long term, it will have a win-win situation, right? So this is what we call as the fiscal stimulus. So this fiscal stimulus, it was given primarily in 2008-9 because global condition was really bad, and nowadays also we are seeing fiscal stimulus packages amid this slowdown. So we can see the government has reduced the corporate income tax rates, right? That is one kind of fiscal boost. The government is giving the various pensions, direct benefit transfer to the account of the people so that they can sustain, right? Government is spending huge amount on the infrastructure also. That is also one kind of the fiscal stimulus only, right? So fiscal stimulus consists of attempts by the governments or the government agencies to financially stimulate an economy. It is an use of monetary or fiscal policy changes to kickstart growth during a recession, right? So primarily we use it during the recession time, during the slowdown, when economy is in a bad shape, when production is not sufficient, and prime purpose is to kickstart the growth. Government can accomplish this by using tactics like lowering interest rate, right? So even the monetary policy can be used by reducing the interest rate, increasing government spending, and quantitative easing, to name a few. This is fiscal stimulus. Fiscal marksmanship. To understand this term, let us know what is the meaning of marksman. So marksman means a person who is skilled in shooting a target. So if a person can accurately shoot the target, that person is called a marksman, and this is mostly used in the military organizations. Coming to the fiscal marksmanship indicates the ability of the government to accurately estimate the budget targets, right? So budget, what is budget? Budget is basically annual financial statement as per the Article 112 of the Constitution of India, right? Annual financial statement, this is basically estimation of the receipts and expenditure of the upcoming fiscal year. What is the meaning of fiscal year? Fiscal year means the year which starts on 1st April and completes on 31st of March. For example, 2019-20 means starting from 1st of April 2019 and completing on 31st of March 2020. So this is an estimation. So the government estimates how much will be the receipt and expenditure based upon the previous year figures as well as the estimates of the future situation, right? What is the condition of globe, how the economy is growing, how the manufacturing sector is doing, how you know what is supposed to be the condition of monsoon. All those things are kept in mind and the estimates are done. In the next year, when the year completes, for example, this estimate is done for the year 1920. And this estimate is done when the budget is introduced on 1st of February 2019. Now, when this year completes and the government comes to know the figure, the actual figure for the year 2019-20, after the year gets completed, then we are able to see that whether the estimate of the revenue and expenditure are closer to the actual or they are very much different from the actual. For example, if we estimated that our fiscal deficit will be 3%, but actually the fiscal deficit happens to be 3.6%. So this shows that the fiscal marksmanship is poor. If it is 3.1%, then this is comparatively better, and if this is accurate 3%, then this is exactly better. This term has been in use in the recent couple of months, therefore this becomes very, very important. Why this has been in use? This has been in use because the government introduced interim budget in the month of August 2019, and when the actual expenditure were estimated in the month of February, then it was noticed that actual expenditure are much more high. So there can be various reasons why actual expenditure are higher than the expected expenditure. Reason can include unexpected slowdown in the economy, or maybe some of the extra expenditure which might have been done by the government. So this fiscal marksmanship, it can be good or poor. Sometimes it is within the control of the government, or sometimes it is out of the control of the government, right? So for example, right now we are under the corona based crisis, economic crisis in the country. So during this time, the budget which was introduced in the month of February, that budget estimate might not hold true, right? So this is completely out of the control of the government. The government did not expect at that time, in the month of February 2020, when the budget was introduced, the government did not know that this coronavirus will actually shock the entire economy, right? So fiscal marksmanship it refers to the precision or accuracy of forecast, target and estimates in say a budget making exercise. The term came into significance when it was used multiple times in the economic survey 2012-13. So first time it was primarily used in the economic survey 2012-13. And why it was used at that point of time? Because FRBM Act the Fiscal Responsibility and Budget Management Act of 2003 laid down the target for the Indian government that fiscal deficit should come to 3% and revenue deficit should become 0% by 2008-9. But because of the recession in the US economy, which ultimately resulted into the global recession, the Indian government has to spend a lot of money in the form of fiscal stimulus. Because of huge spending, we exceeded the estimated estimated expenditure multiple times. So at that time, the then Chief Economic Advisor, Mr. Raghuram Rajan, he indicated that the fiscal marksmanship skills of the government are getting poor. There is next term, that is fiscal drag. This is very, very important and very conceptual also. To understand this term, you should understand few concepts. Like, first concept you should understand is progressive taxation. Right? So in the progressive taxation, suppose we take income tax. So progressive taxation is a system of taxation according to which the rates of tax are decided. In India, it is used in the income tax. Suppose in case of an individual, Mr. A, the tax up to 2.5 lakh is 0%. Between 2.5 to 5 lakh, this is 10%. Between 5 to 10, this is 20%. And between 10 to more than 10, this is 30%. These are the rates of tax. So as the income is increasing, the rates of tax are increasing. Friends, I am not telling you the exact tax slabs in the country. I am just giving you an example, right? So this is how the progressive taxation works, that as the increase of the person, as there is an increase in the income of the person, the tax rates keep increasing. The tax rates keep increasing, right? Now, this is the progressive taxation. Now, what is fiscal drag? So, suppose Mr. A's income was rupees 9 lakh. That means he was paying 20% income tax, that is 1.8 lakh. For the sake of simplicity, I am not going much into detail about the calculation. You just suppose this is 1.8 lakh. Now the income of the Mr. A increases to rupees 12 lakh. And this increase is primarily because of two reasons. One is the inflation. There is high inflation in the economy, and there is some salaries rise also. Salary rise or salary hike by the employer. So when income increases to 12 lakh, he has to pay income tax at the rate of 30% for the extra amount. So he has to pay 2 lakh for the initial 10 lakh and 30% for the 2 lakh, that is 60,000. So he has to pay 2.6 lakh amount, right? So you can see there is a certain jump of 0.8 lakh or 80,000 in the income of the in the tax expenditure of the Mr. A. So increase in the income is from 9 lakh to 12 lakh, but increase in the expenditure is in the tax expenditure is much more high. So from 1.8 to 2.6. So increase in tax amount is more than increase in the income, right? So because of the inflation and because of the salary rise, the tax expenditure has increased. When tax expenditure increases, that means the savings in the pocket of Mr. A got reduced, right? The savings got reduced. That means his consumer spending capacity gets reduced. If his consumer spending or purchasing power is reduced, that means demand for the goods and services is reduced. If the demand for the goods and services is reduced, that means supply cannot decrease suddenly. That means the prices of the goods and services will reduce. So prices of the goods and services reduce means there will be a situation of deflation. So deflation is opposite of the inflation. So in the deflation, the prices are rising as compared to inflation, where prices are in case of inflation the prices are rising, and in case of deflation the prices are decreasing, right? So you can see, because of the progressive taxation and rise in because of the progressive taxation, rise in the tax expenditure is more than the proportionate rise in the income, and because of that there is deflationary condition. So this process is called fiscal drag, right? So when, because of inflation, primarily because of inflation and because of the income growth, the overall spending of the person increases as progressive taxation is in effect, and ultimately leading to the reduction in consumer spending and deflation. So this is called fiscal drag. So you can see over here, fiscal drag is a result of decreased consumer spending as a result of increased taxation that eventually reduces aggregate demand, which leads to deflationary pressures. So we have seen it is a result of decreased consumer spending of Mr. A. Progressive taxation, whereby individuals are moved into higher tax bracket. So Mr. A moved from bracket of 20% to 30% because of inflation or increased income, is a fiscal policy that results in fiscal drag. Progressive taxation allows for increased government taxation without actually increasing tax rates, right? So the government taxation actually increased without increasing the tax rates. Fiscal drag can be seen as an automatic fiscal stabilizer, as it controls a rapidly expanding economy from overheating, right? This is very important. So this acts as a stabilizer. Right? How stabilizer? So when there is high inflation in the economy and the income of the people is increasing, that means the economy is doing good. When economy is doing good, it is good, it is desirable, but this inflation can go beyond a control. If this inflation goes beyond control, it will be undesirable situation, because if inflation increases beyond 6%, especially in the context of India, it will eat away all the savings of the poor people. It will have a huge burden on the day-to-day expenditure of the poor people. It is called unlegislated tax, the tax which is not levied by the government but which eats away the savings and income of the people. So this inflation will suddenly rise. So this progressive taxation, it actually comes as a rescue during the high growth situation, because it reduces the consumer spending by increasing the tax rates, by increasing the tax expenditure, and ultimately the inflation cannot go beyond a level. So this fiscal drag is also having a positive phenomena, right? I hope the concept is clear to you. Now coming to the fiscal profligacy. So profligacy, what is the meaning of profligacy? So profligacy means the act of spending money or using something in a way that it is waste and is not wise. So wasteful expenditure and unwise expenditure, that is called fiscal profligacy, right? So there are various controversial views about many welfare measures which are taken by the government. Many times government gives, especially the state government, they distribute sarees to the women, they distribute some household items to the women or to the households in general. At that time the question arises whether that those sarees or day-to-day household item, will that be building their skills? Will that be increasing the productive capacity of the country? Is that the wise expenditure? Right? So whether the expenditure is going to benefit the country in the long term or not, that is always kept in mind. If the money is spent on the infrastructure, it is built for, it is spent for the road construction and other things, then it is always good, because It will increase the productive capacity of the people. It will increase the production in the country. But unproductive expenditure, wasteful expenditure, those expenditure are undesirable and are harmful for the country in the long term. One of the example can be fuel subsidy. Fuel subsidy can be harmful because if there is high fuel subsidy, the people will not know the adverse impact which are caused by the use of crude oil based products, the inflation, the drain of the foreign exchange reserves, increase in the current account deficit, increase in the balance of payment crisis. All those negative impact of the crude oil usage will not be visible to the people if high fuel subsidy is given, right? If fuel subsidy is kept low, people have to pay high prices for the petrol and the diesel. They will understand and they will know the wise use of the product. They will be forced to use the petroleum products with prudence, right? So I hope the concept of fiscal profligacy is clear. Next is fiscal capacity. Fiscal capacity, that means the revenue generation capacity. So revenue can come from tax revenue or non-tax revenue. Non-tax revenue is very less, so primarily it is the tax revenue. And tax revenue is based upon what? It is based upon the condition of industry, per capita income of the people, right? The efficiency of tax department, etc., right? So if industry is doing good, then taxes will increase. If per capita income of the people is good, for example in the USA, per capita income of the people is good, so they can pay high taxes. If efficiency of the tax department is good, then automatically the tax collection can increase. So depending upon these three factors and many more other factors, it can be decided whether the revenue generation capacity of the government is good or not. So fiscal capacity in economics is the ability of the government, groups, institutions, etc. to generate the revenue. The fiscal capacity of the government depends on a variety of factors, including industrial capacity, natural resource wealth, and personal income. So natural resource wealth is also important, for example, by sale of the coal resources, by sale of the spectrum, etc. So that is also very important. For example, in the Middle East countries, they have huge oil reserves. So their fiscal capacity is good because they can always sell the oil and they can generate the revenue. So this is about the fiscal capacity. With this, I complete this session and I hope you enjoyed. I have discussed all the related concepts and you should revise this lecture in the fast forward manner and you will really like the lecture. Thank you very much. God bless you.